real estate is a wonderful asset class that may reach a lot of people over the years. Similarly to the diversified Canadian dividend portfolio, real estate investments is a no-brainer addition to your portfolio. Hello everyone, Alex is here. I hope you're doing well. I hope you're staying safe. And I hope you're ready to buy some properties today. We're going to be taking a look at real estate ETFs and how those can become a very good chunk of your portfolio. How you can actually get some passive income from such investments, because real estate is another great sector that has to be part of every single investment portfolio. Before we start, don't forget to smash the like button for YouTube algorithm. That's going to help me a lot. That's going to help YouTube a lot because my video is going to be viral and everyone's going to be watching it and everyone's going to be learning about investing. That's my goal. That's what I want to do. And let's start. You either buy properties and manage all that on your own, or you can do it by investing into real estate stocks, REITs, or investing into real estate ETFs, REIT ETFs. And the difference here is very simple. If you invest into real estate stocks, you basically need to find these companies that manages different real estate properties and all that. If you invest into real estate ETFs, you basically invest into all of these real estate stocks at the same time. So you're diversifying yourself from start. Great tool to use, probably. That's what I do for my portfolio when I invest into real estate sector. All these real estate stocks and how they work and what the company is good or not. I try to also invest in them as well, but it takes a lot of time and effort to actually research those and see what is happening there and how they can sustain the dividend payments, if they're growing or not. It's a lot of things you need to consider. But if you invest into REIT ETFs, you can make your portfolio hands-free and have this real estate sector stable and profitable, because they're going to be paying you dividends every single month. Because how the real estate works is that people actually rent out these properties and they pay rent to all these real estate owners, REIT companies, and part of that rent actually goes to investors as dividends. That's the whole business. And it's of course up to you how you want to be involved with real estate. You can totally buy a property and rent it out on Airbnb or just as a long-term lease to a family or a couple or whatever. And you're going to be managing everything on your own. All the payments and all the renovations and all the mortgage payments and condo fees and whatever else comes into play. Utilities, of course, and all that. But do you want to do it? If yes, go for it. That's totally a really good thing to do, and some people actually make a lot of money out of that. But if you don't want to manage all that hassle but still want to be involved with real estate, that's where investments and stock market actually comes into play with real estate stocks and real estate ETFs. And as we just talked about, real estate stocks, REIT stocks, is just regular companies who actually own these real estate properties and collect rent from them. Where for real estate ETF, there are actually two of those. First one is the real estate ETFs who actually invest into real estate stocks directly, or the other one is that real estate ETFs who actually invest into other real estate ETFs. Very confusing? I think so. The whole difference is that some real estate ETFs actually invest into other real estate ETFs, and those real estate ETFs actually invest into real estate stocks. So it's a way of crazy rabbit hole diversification that can be part of your portfolio, and you don't have to do anything for that. You just buy these ETFs, hold them in your portfolio, and collect dividends. That's pretty much it. And the biggest question is here, how to pick the best real estate ETF. There are actually three different factors you need to consider. The first factor you need to consider is a MER, or management fee. This is probably one of the most important one out there, because MER for REIT ETFs actually tend to be on the higher side, going all the way from 0.4% to somewhere like 0.9%. It is pretty high actually if you compare it to a passively managed low fee ETF like VCN, where the fee is 0.05%. So basically, the lower the fee you can get for your REIT ETF, the more returns you're going to be getting back from these investments. The second factor to consider is that you need to make sure that your REIT ETF is actually properly diversified. For example, some of the REIT ETFs have exposure to only the largest REIT stocks, and they do not consider the smaller cap companies, which is not necessarily good from a diversification standpoint, because the smaller cap companies have higher growth potential over the long-term period, meaning that you're going to be getting more returns back from stocks like that. And the third factor to consider is only take a look at the largest REIT ETFs, because sometimes it becomes annoying when you cannot actually sell or buy these ETFs if they're somewhere on the lower side, like very small ETFs and all that. And those ETFs sometimes can be closed as well. And for passive investors like myself, I tend to buy these stocks and ETFs and forget about those for 20-30 years, because time in the market is way better than time in the market. Another thing to consider for REIT ETFs is that they're not necessarily growth ETFs, right? So you cannot expect a lot of growth from stocks and ETFs like that. If you compare it to a TSX or S&P 500 index, you can see that the REIT ETFs and REIT stocks actually falling behind the S&P 500 index. And that means that REIT stocks and REIT ETFs has to have some allocation in your portfolio, but not necessarily the biggest one, right? So you gotta invest into growth stocks and ETFs as well, something like VFV as the S&P 500 index ETF. Now actually let's take a look what are these the best REIT ETFs that we have on the Canadian stock market. Boom. And the first one is BMO Equal Weight REITs Index ETF. The ticker symbol is ZRE.TO. This REIT ETFs owns approximately equal positions in 21 of Canada's top real estate investment trusts. Their portfolio is periodically rebalanced as certain REITs outperform their peers, which leads to them having a bigger position. This equal weight perspective has a pretty big advantage compared to the other REIT ETFs, which is exactly one of the factors we talked about earlier today. It doesn't favor the largest REITs, it actually equally invests into all the top REITs in Canada. A really good example is going to be last year during the pandemic, where one of the largest REIT stocks, RioCan, actually experienced a pretty bad time and stock just dropped significantly. Actually, they dropped the dividend as well and all that, so it was a pretty harsh time for them, right? But this ETF actually didn't fall that bad last year because they actually equally invest into other stocks as well, which is pretty good. And that is exactly why this is one of my favorite REIT ETFs. The way they structured their investment strategy is actually pretty neat. They consider high returns and stable dividends. Looking at their holdings and all the REIT stocks they actually invested into, you can see that the weight they have in their portfolio is actually very similar. And that is exactly what the equally weighted portfolio means. This ETF is also fairly large. It has around $760 million in their assets under management, and they trade roughly around 36,000 shares per day, which is pretty good. You're not going to have any troubles investing into this stock and also selling it if there's going to be a need for that. There are actually two problems with this ETF. The first one is the management expense ratio, MER, which is at 0.61%, which is alright if you compare it to mutual funds. And the second problem with this ETF, that their dividend yield is actually not that great. It's at 4.1%, which is still alright if you compare it to the stocks, even the high dividend stocks or the blue chip dividend stocks, right? But for a real estate stock, it's actually a little on the lower side. And this is partially because of the higher management expense ratio and also the stocks they invested into, which are the largest REITs in Canada, where the yields are not necessarily high enough if you compare it to the other smaller cap companies. And if you are looking for higher returns in terms of dividends back, then you probably want to consider other REIT ETFs out there, which I'm going to be talking about later today, so you're going to stick around. Looking at the performance of this ETF is actually pretty good. Even with the market crash of last year, this ETF is actually back to the pre-pandemic levels, which is pretty good. And if you look 10 years back, you can see this consistent growth, consistent share price appreciation over the long-term period. That's what we're looking from our stocks, from our ETFs. We always want to see this consistent market share appreciation. Let's move on to the next one, which is the iShares S&P TSX Capped REIT Index ETF. The ticker symbol is XRE.TO. And this REIT ETF has actually been around for the longest among all the other ETFs we're looking at today. It's been on TSX since 2002, which gives us a lot of time to look back into history and see what has actually happened with it, and if it had sustainable yearly returns that we can rely on. I would consider this REIT ETF as a solid choice, as over the last 10 years, it returns around 6.5% every single year. And the market crash of last year also factored in these numbers. If you take a look at 10 years prior to the market crash of last year, you can see the double-digit returns year over year, which is pretty good and consistent, so we can rely on these returns for the future as well, as we are probably going to be in the bull market for the next little while. The other advantage of this ETF is actually its size. They have around $1.4 billion in assets under management. This is huge, right? And the stocks they have in their portfolio is actually one of the top companies, top real estate companies in Canada. Companies such as Canadian Apartment Properties or Rio Canada Real Estate Investment Trust. Looking at their distributions or dividend yield is actually at 2.1%, which is on the lower side, but I think once the companies are gonna start coming back from last year's market crash, they're going to be starting increasing their dividend yields, so as the ETF as well, because the ETF just invest into this REIT stocks directly. So the distribution is going to be reflected in the ETF as well. The MER for this ETF is also on the higher side, is at 0.61%, exactly the same as for BMO one we just talked about as well. Looking at the performance of this ETF is actually very similar to the BMO we just talked about, where it recovered pretty nicely from the last year market crash, and if you take a look 10 years prior to the market crash, it actually has a pretty steady growth over that time period. And now let's take a look at the final REIT ETF in this list today, and it's my favorite, which is Vanguard FTSE Canadian Capped REIT ETF. The ticker symbol is VRE.TO. And Vanguard passively managed ETFs actually dominate the stock market. And why? Because of the lowest fees they have across all other ETFs, and also because the company actually builds their products to last for a long-term period. And Vanguard REIT ETF is actually no exception. They have the lowest fee across all other REIT ETFs, which is at 0.38%, which is great. This is actually pretty low fee even compared to the other passively managed ETFs out there. And if you compare to the other REIT ETFs we just talked about, this Vanguard REIT ETF can bring you additional $20, $35 per year for your $10,000 investment, which can add up very fast over time. But no doubt, this ETF also has some struggles in it, like everything else. First, that their assets under management is actually the lowest among all other ETFs we just talked about. They have it at $320 million, which is still a chunk of money, right? So we shouldn't worry about it. And their liquidity is actually pretty high as well. It's around 20,000 shares per day, which is more than enough for us to actually buy and sell whenever we want. And also looking at their holdings, they invest into the top REIT stocks pretty heavily. You can see that have around 15% allocation for Canadian apartment properties, around 11% allocation with First Service Corporation, they have around 11% allocation to Rio Canada, and around 9% for Allowed Properties REIT. So their top 5 investments actually have around 50% of their entire portfolio allocation, which means that they're pretty heavily invested into these 5 companies. So you gotta consider this whenever you make a decision if you want to invest into this REIT ETF or not. Looking at the performance of this ETF, you can also see that it actually recovered pretty nicely from the last year market crash, and they're also in a nice steady growth over the last 10 years prior to the market crash of last year. Their current dividend yield is around 3.16%, which is also on the lower side, and if you're looking for an earner, a dividend earner stock, this is not the right for you. And I actually have a video about dividend earners, so you can look it up there and see where you can get this highest yield possible, around 9%, right? And that would become your passive income source. This REIT stocks and REIT ETFs is actually something you want to have in your portfolio as a sector, because you have to have exposure into real estate. So I would say, in my opinion, among all these top three REIT ETFs, Vanguard is actually wins the list. And I have it in my portfolio, and I keep investing into this REIT ETF and getting this dividends back every single month that I love and enjoy, and also get this share price appreciation over the long-term period. And Vanguard is gonna stay around for a long time, so you shouldn't worry about them for at least next 15, 20, 30 years, because Vanguard is the company that built to last. So if you consider real estate, invest into real estate, this is one of the ways how you can do it, and this is actually a very easy entrance for real estate opportunities. With all that, thank you for watching. Don't forget to smash that like button, subscribe to my channel, hit the bell, And I'll see you around. Keep investing and get your dividends. I'll see you around. Cheers, bye.